I travel and meet with our clients about once or twice a week, the biggest question and concern that we've been getting from clients, all of you, has been how the Federal Reserve, America's central bank, is going to be normalizing their actions. As all of you know, the Federal Reserve has been embarking on a journey of massive economic stimulus to our economy in terms of very low rates and asset purchases at a very large scale to try to boost our economy. We'll try to answer that today. So I'll do a quick review of the Fed rate hikes we've been having recently, the Fed balance sheet. And at Marquette, we did a study that culminated in a model where we could take into account the Fed hikes and balance sheet and how that affects bond returns. And in fact, it could affect all investment returns as well. We'll do a high-level overview of that, and we'll cover pros and cons. And then we'll look to the future. We'll take a look at those results of our model. We'll also take a look at the future of the composition of the Federal Open Market Committee, which is a committee within the Federal Reserve that sets interest rates and also asset purchases for their balance sheet. And over here, I've just got a fun little cartoon that shows the dramatic rise and fall in the Fed funds rate. This is the key short-term interest rate that the Federal Reserve controls, rising under Paul Volcker, the Fed chair at the time in the 70s, to battle against inflation, and then dropping a great deal through Greenspan, Bernanke, and today Janet Yellen, after several years of ZIRP, the zero interest rate policy, which has just started to climb the past couple of years. So we'll take a look at that same line here, and let's try to analyze this. We've got here superimposed the 10-year Treasury yield, which all of you know is a bellwether bond yield that's dictated by the markets. When there's missile flying out of North Korea over Japan, the market wants a safe haven to buy. They buy US Treasury bonds, driving up prices and driving down yields. So that's what we're seeing here. Now, the 10-year yield is also informed by the Fed funds rate, which is a shorter term rate, because the shorter or the lower the Fed funds rate can go, the lower the 10-year yield could go. Let's superimpose on here bond returns. We have annual bond returns for core bonds in the black and for high yield bonds in the gray. What can we try to glean from this correlation here? Well, one thing that's pretty obvious is as the red line rose in the 70s, it depressed on bond prices or bond returns. As the red line dropped all the way to today, it's been propping up bond returns. We see the black bars in the 80s had a dramatic rise, and that's because when rates rise, it depresses bond prices. When rates drop, it pushes up bond prices. Another thing is, the more dramatic the drop, the greater the rise. More recently, we've had some drops, but that's only affected the bond returns slightly, a lot less than what we had back in the 80s. When you look at the gray bars, we take out the outliers, we also see that gradual compression of bond returns. So we see that for both core bonds and high yield bonds. The Fed is projected to continue to hike rates. And what this means is they're going to make it less easy for businesses to borrow and therefore be less stimulative for boosting the economy. How is that going to affect bond returns? We've just been eyeballing this. The model we constructed is based on statistical analysis, and that's going to do this in a more rigorous quantitative manner. Same thing with the Federal Reserve's balance sheet. Now, our central bank, the Federal Reserve, I mentioned earlier, has been engaging in large-scale asset purchases, buying treasury bonds, buying mortgage-backed securities to boost our economy. That when they do this, they flood our economy with cash. They also prop up bond prices and asset prices. Where it stands today, the Federal Reserve's balance sheet is at $4.5 trillion. That's about $2.5 trillion in treasury bonds and $2 trillion in mortgage-backed securities. The European Union, their central bank is called the ECB. They've been doing the same thing. Japan has their central bank called the Bank of Japan, doing exactly the same thing. This is huge. This is a dramatic difference from where we were pre-crisis in 2008. When we superimpose the black core bond returns and the gray high yield bond returns, what can we glean from this? Again, we're going to try to eyeball this. Well, 2008, we had the financial crisis. the Fed bought a lot of bonds to try to prop up and support our economy, and it's caused a 1-year lag in bond return boosts going forward. Now, going forward, the Fed is going to start trimming their balance sheet. They announced this a week and a half ago. They're planning to reduce the balance sheet by $1.5 trillion over 5 years. How is that going to affect our bond returns? Now, again, we've just been eyeballing this. Our model is going to do this in a rigorous quantitative fashion. What is our model? It's, again, using statistical analysis, more specifically, multi-factor regression. I actually don't need to explain what multi-factor regression is. All of you know exactly what it is. You use it every day. When you look at your Marquette reports and you look at your alpha and your beta of your bond portfolio or your equities portfolio versus the market, that's based on regression. So what we're doing here is we're putting in as inputs the Fed funds rate, the Fed balance sheet, and the price of oil. These are going to be our independent variables. We'll feed that into our model. We actually go through a 2-step approach. The first step, we model out the 10-year yield and also the spread over the 10-year yield. And then we get the alpha and beta, same as your portfolio, the alpha and the beta. Then we do a second step, and we get estimated core bond returns, high yield, EMD returns. These are our dependent variables. So before we take a look at the results, let's take a look at pros and cons of doing this. Again, statistical analysis. The first thing is, we're not having me sit here and eyeball things. It's unbiased. It's purely based on the numbers. The second is, no one has a crystal ball. We all want to have a crystal ball. This is one way to let us use the past to inform the future. Now, the past data we're using here is 2001 to 2016 data. And then the third is, if we plug into our model, let's say 2010, the Fed funds rate for then and the balance sheet for 2010, we can get the model's prediction for 2010's bond returns. We can match that with the actual bond returns to see how strong our model is. So we'll take a look at that. Cons. So again, our model only feeds into it, takes into account the Fed funds rate, balance sheet, and price of oil. We can't account for the million other things that factor into bond prices. We can't account for changes in geopolitics. We can't account for changes in technology. The best way to look at this would be, because we're using data from 2001 to 2016, the model sort of understands the trend from 2001 to 2016. We want to sort of project that similar trend going forward. Lastly, we can't account for Trump's tweets. Now, one thing I want to emphasize is the model's not end-all be-all. If the model says 2018 will have a 5.31% return in bank loans, I can bet you $1 million that won't be the actual return for 2018. The key here is the model, a statistical model, can only give us, at best, a sense of direction, up or down, and magnitude, big or small. So without further ado, let's take a look at the results. We've got here, in the blue, these are the core bond actual annual returns. If we plug into the model, for example, 2001's Fed funds rate, balance sheet, that's what we get from our model. It's back-testing pretty confidently. I've got pretty good confidence in the ability of this model. Let's start projecting forward. Now, we've got 3 scenarios here. The first scenario is where we assume the Fed doesn't hike any more rates and the Fed doesn't change the balance sheet. So they just sort of stay put where we are now. This is what we get. As a second scenario, we assume the Fed hikes each year going forward by 25 basis points on a sort of average scale going forward and doesn't change the balance sheet. This is what we're seeing. So what's interesting here is it's actually, I'm hoping you could see that, it's actually dropping returns slightly, maybe on the order of 10 or so basis points. If the Fed continues to hike rates and also starts reducing the balance sheet by $0.3 trillion. Why 0.3? Because $1.5 trillion over 5 years divided by 5 is 0.3 trillion. So when we do that, we have the third bar here, which is slightly even lower in return. So roughly a 10 to 20 basis points trimming. This gives us sort of the result that As the Fed reduces their stimulus, raises rates more, and trims their balance sheet, it'll curb our bond returns. So the key takeaway here is the greater the hikes and the balance sheet reductions, they result in lower returns. Let's take a look at bank loans. Now for bank loans, we can incorporate the price of oil because oil doesn't really affect core bonds, but it does for credit. Again, actual numbers, actual annual returns for bank loans. Our model, let's just pick 2009, for example. We feed to it 2009's Fed funds rate, balance sheet level, as well as the price of oil. This is what we get from our model, a pretty sort of high level of confidence, at least from my standpoint. We've got 3 different scenarios here, which we'll use throughout for high yield and EMD, emerging markets debt as well. Here we assume the baseline where the Fed hikes by 25 basis points, reduces the balance sheet by 0.3 trillion, and the price of oil doesn't change. Those are our returns. If we give it an upward shock, if we increase the price of oil by $25, and then we assume the Fed pumps the brakes even more. They hike by not 25 basis points, but 50 basis points now, and they also trim the balance sheet by 0.3 trillion. We're shocking the price of oil in 2008 only, so we see a spike up in the bond return for bank loans, and then in the outer years, we have a slight reduction because the Fed is pumping the brakes more. If we go the inverse direction, let's say the price of oil drops by $25, and the Fed now, instead of pumping the brakes, the Fed steps on the gas. They don't hike rates, they keep it at 0, that bottom scenario there, and they don't change the balance sheet. What we have is 2018, it reduces the returns for bank loans because the price of oil dropped, but the Fed steps on the gas and it can actually bring up bond returns. At least this is what our statistical model is telling us. So key sort of takeaways here, again, more hikes, balance sheet trimming that reduces returns. Oil is a big factor here. If oil goes up, it helps returns, the other way, vice versa. And the Fed has the power to correct reverse oil's effect. Now, the next 2 asset classes, we have exactly the same results, so I'll quickly go through these and not go into the details. Actual and model backtest, and then we got the 3 scenarios here, with the middle being a shock up in the price of oil, the Fed pumps the brakes, the outer years it reduces returns. The last scenario, oil goes down, the Fed steps on the gas, and it can actually enhance returns. So same results here, and we'll do the same for EMD as well. So now, quick takeaways are, it's not all doom and gloom. The Fed, as they continue to normalize rates, bringing rates up, and trim our balance sheet, you saw our huge balance sheet then, there's a little bit of silver lining here. You've got the European Central Bank and the Bank of Japan, they're still being stimulative, so we'll continue to see their balance sheets rise. Mario Draghi, the president of the European Central Bank, has been talking more hawkish talk, where he has been expressing concern over their balance sheet, and he is set to reduce their balance sheet at some point. And then the other silver lining is, which we'll take a look at in my second section here, the composition of the Fed. They're expected to remain quite dovish. Let's take a look at those terms first. What does hawkish and dovish mean? You've got Fed members that, when they're hawkish, they typically want to decrease stimulus. When they're dovish, they typically want to increase stimulus. And this is because hawkish members want to contain inflation, while dovish members want to minimize unemployment. Hawkish members want to do this by increasing rates. When you increase rates, it makes it harder for businesses to borrow, and it raises interest rates, and therefore there's less inflation. When you decrease rates, it makes it easier for businesses to borrow, there's more hiring, it reduces the unemployment rate. The other thing that they can do is, when you, let's say for a dovish member, when you increase the balance sheet, you're buying assets, you're propping up asset prices, you're flooding the economy with cash. That drives commerce, and that drives more hiring, therefore lower unemployment. So these are your 2 different kinds of Fed members. Let's take a look at Janet Yellen. She's our current Fed chair. Nat mentioned earlier that her term is set to expire this coming February. And so she's been one of the most dovish Fed chairs that we've ever had. If she does leave the Fed chair post come February, I personally am not sure how much of a dovish Fed chair we might have. Now, Trump might reappoint her, and so the Fed might still be extremely dovish. What else do we know about Janet Yellen? We've had a chance to take a look at her research papers and speeches, and she's very much a dovish advocate. She's also very much a Keynesian economist, meaning that she wants to use monetary policy, low rates, asset purchases to the balance sheet to stabilize the economy, as opposed to a supply-side economist following Reagan's trickle-down principles where you lower taxes to boost the economy, somewhat like what Trump is doing now that we've got the announcement of the tax cuts a couple days ago. Who might be the next Fed chair? Gary Cohen has been in the news. He is a trader at Goldman Sachs. He was their head of fixed income. He's one of about half a dozen or so likely candidates. What do we know about Gary Cohen? Taking a look at his background, he is a supporter of this Glass-Steagall Act, which would reintroduce the separation of commercial and investment banking. He promotes globalism, and he also is against populism. That's about all we know. He hasn't really written much or said much about whether he might be hawkish or dovish. So the jury's still out whether our next Fed chair, if it's going to be Gary Cohen at all, might be more dovish or hawkish. Now, with that aside, let's take a look at the future of the composition of the Federal Open Market Committee. This is the group within the Federal Reserve that sets interest rates as well as asset purchases for their balance sheet and either stimulates the economy, pumping the gas or pumping the brakes. These are the various members. You've got permanent members, you've got alternate members there that have the opportunity to vote, but the permanent members always have to vote. There's sort of musical chairs here. These are the assigned seating from the Fed. They release this to the public where each of the cities, they sort of take alternating spots. We've got Yellen and Stan Fisher, the vice chair, who are set to have their terms expire next year. So we got question marks for the future years. Now, if we just do sort of simple math, when we look at each member and their speeches and their papers, how dovish or hawkish they are, we label them as either a dove, a hawk, or a centrist. And we just did sort of simple math here was sort of a dove-o-meter, where we've got +5 dovish members, -2 hawkish members. That gives us a +3 in terms of the Fed being very, very dovish. We do the same for 2018, 19, and 20. What does this tell us? The Fed is, at least from this, expected to remain fairly dovish going forward. So there's your silver lining. You've got the Fed, they're raising rates, they're trimming the balance sheet. That's going to be less supportive of the economy. But they are still going to be very dovish, which means they're more prone to want to raise rates less and reduce the balance sheet less and still be very supportive of the economy. So key takeaways here, we saw from our model, the hikes and the balance sheet reductions are a headwind for returns, but the Fed's expected to be very, very dovish, and so that could be a tailwind for returns. Another key takeaway is you can't time politics, like what we've learned from Nat. And the Fed's also expected to be very market and data-driven. They don't want to shock our economy. And so what we would advise is maintaining your strategic allocations according to your organization's specific, unique return targets. What can we control? We want to minimize fees and don't put all your eggs in one basket. And I'll leave you with a fun little cartoon here.